Interest rates for savings accounts are falling. So are there other low-risk options for you to stash your cash?
With rates going down from 1st May to 3.3% at some banks, offering the highest interest rates among savings accounts in Singapore, customers with $150,000 at the highest effective rate could earn about $1,000 less.
What's going to happen is that your savings, just earning 2 to 3%, may actually be eroded by inflation over the long term.
With the cut in rates, experts say there are other ways to optimize your savings.
One of the things that happens when bank savings account decline is that some people might find that the CPF special account becomes more attractive because the CPF special account gives you a minimum interest rate of 4% per annum. So that becomes a lot higher than what you can earn with the bank. Obviously, there's a trade-off here, and the main trade-off with CPF is that once you top up your savings to your CPF special account, it's locked in and it goes into your retirement account when you are age 55 and you receive it through your CPF life payout from age 65 onwards. So it's certainly less liquid compared to keeping it into your savings account.
Another option you can consider is money market funds. A money market fund is a mutual fund that invests in short-term, high-quality debt instruments.
This cash management account essentially put your investments into very low-risk money market funds, which would then potentially be able to generate you maybe a slightly higher return than, say, leaving your savings in a bank untouched. So I think that is one possible option that some people would consider. But I want to caution as well that at the end of the day, even though these are very low-risk investments in money market funds with very short duration bonds, they are after all still investments and they're not SDIC protected. So you are getting maybe a slightly higher return, but you are taking a bit of a slightly higher risk as well.
Money market fund, generally speaking, liquidity is not instantaneous also. So it's not like a bank where you can just withdraw your money right now if you need the money. With money market funds, even if you want to withdraw your money, depending on the provider, it might take a few days for them to liquidate the holdings and to return to you the funds.
The downward revision of interest rates comes on the back of rate cuts by the US Federal Reserve over the past year. And experts say the current rate environment favors bonds.
If you're expecting interest rate to drop, by right, the natural asset class to go into is probably the bonds and fixed income space. So if you're able to get into a fixed income space, you probably can lock in a good rate. Even if the rate doesn't hold, you probably get some form of capital appreciation, which is capital gains. So that's one, and if you're looking at maybe a 3 to 5 years horizon, I think this asset class is pretty cool.
To stay ahead of inflation, analysts say it's important to look at investment strategies with a long-term horizon.
You need to expose yourself to equities, stocks. You need to expose yourself to gold, maybe to real estate through REITs. And the best instruments to do that at the lowest possible costs are what is called exchange-traded funds, or ETFs. I would go with simple ETFs. I would go with real asset-backed ETFs versus synthetics. And then I would do an analysis on total cost of ownership, expense ratio, bid and ask spread, tracking error. I will look at who's the manager. So, not all ETFs are created equal, if you will. In general, as a way to get exposure to all the asset classes I mentioned earlier, or 99% of the asset classes out there, I think ETFs are just a winning proposition. Most ETFs invest passively. Those are the ones I'm talking about, which means they follow an index. There's not a fund manager who makes decisions on a daily basis whether to invest somewhere. And because it's so difficult to beat the market, following the index is actually your best bet at achieving good returns over the long term.
So I think for most people with excess savings, especially if they are young enough, they should take a bit of that investment risk to really enter the market and take a long-term view of the market as well. Not expecting to make quick returns in a short period of a few years, but if you're looking at it from a 1 decade, 2 decades timeline, then your chances of earning a return you want is a lot higher.